There were a few big headlines this week from major Wall Street institutions, and they're betting on one of the more lucrative layers of the RWA and stablecoin stack, and that's yield infrastructure. BlackRock filed for a new tokenized fund. It's designed specifically to be reserve backing for stablecoins. Apollo made a deal back in February with Morpho worth $90 million. Morpho is a DeFi lending protocol, and their TVL, total value locked on chain, grew from $7.7 billion to $12 billion in just those 3 months. Circle raised $222 million for a blockchain called ARC, which is built for institutional finance. They did that at a $3 billion valuation. And BlackRock, Apollo, the parent company in New York Stock Exchange, ICE, all participated, with Andreessen Horowitz, A16Z leading. Yield is one of the more profitable layers of the digital asset stack. The question of who exactly gets to capture it is still up for grabs. That's what we're going to talk about today. I'm Samantha Lewis, and this is Money Moves. Hey guys.
Yo.
Welcome back to Money Moves. It's sad not to be in person like we were last week. That was fun. But here we are. So this week, we're going to dive into some of the big announcements that happened this week. All of those center around a big question in the digital asset economy, which is who captures the lucrative yield layer. Dave, before we go into all that and the deep dive around that, let's start with you. Kick us off, walk us through the business model of stablecoin issuers and how now there's the yield ecosystems that have popped up around these stablecoin issuers.
Exactly, yeah. And to understand why the question of who gets the yield is so important, let's start with how stablecoins work from a business model perspective. From the simplest point of view, stablecoin issuers take in fiat currencies, primarily US dollars, and they invest those almost entirely in short-dated US Treasury securities. They earn interest income on those US Treasury securities, and they keep all of it. There are a few big differences that I'm going to highlight between Circle and Tether and how they work and how their business models are different. But generally speaking, when they take in these fiat currencies, they issue on a one-to-one basis a stablecoin token, USDC for Circle or USDT for Tether, and they take that money and they invest it and they earn all of the revenue from the investment income that they get. Today, that's a huge amount of money that they're actually investing. So I ran the math right before the show. If you take Circle and Tether combined, they are a top 15 holder of US Treasury securities globally. They're about on par, depending on the month, with South Korea, Saudi Arabia, and Singapore, which are obviously huge countries in the geopolitical scheme of things. Which means that Circle and Tether make a tremendous amount of money. Circle just reported its earnings. Tether is famously a private entity, and so its finances are fairly opaque, but it's making a tremendous amount of money in the billions of dollars, each of these companies annually. And the vast majority of their revenue comes from that interest income on the reserves. Just to highlight a key difference between Circle and Tether, Circle's about $75 billion in market capitalization. Tether's about $190 billion in market capitalization, so more than double the size of USDC. USDC is issued under the Genius Act, which is the US federal legislation that governs the issuance of stablecoins. And that legislation says you can only invest the stablecoin reserves in short-dated US Treasury securities, commercial bank deposits, or repo arrangements involving US Treasury securities. Tether, on the other hand, does not exist under that framework. And so as of today, its reserves are only 75% in cash and cash equivalents, so US Treasury securities. The other 25% of Tether's reserves are in precious metals, Bitcoin, public equities, 3% in other investments, which we're not really sure what that is, and over 8% in secured loans. A asterisk here that says none of those to affiliated entities. Because of the investment profile being far riskier than Circle, it makes a huge amount more money on its reserves. It actually, as of today, has a $9 billion equity buffer. So the reserves are $9 billion higher than what the circulating supply of Tether. And so it's just really interesting to highlight that even within the two biggest stablecoins, their business models, while similar in take in money, invest, earn interest, what they can invest in is actually very different. And that means that Tether historically has made a whole lot more money. To round this all out, the question that everyone's asking is, should the stablecoin issuers be the ones that continue to take 100% of the yield on the underlying stablecoin reserves? And there's a whole hell of a lot of companies, mine included, that are really focused on creating utilities to help stablecoin holders capture yield on their stablecoin holdings, which currently pay 0%. So with that sort of introduction, let's get into it.
Yeah, there are a lot of different ways people are trying to find that yield, to seek that yield now. Ian, any comments on that before we dive
Yeah, I mean,
in?
I think that I don't want to bury the lead. The lead is that in a global world that's internet and digitally native, the utility value of digital dollars in the form of stablecoins is so high that there's almost $400 billion worth of stablecoin owners that see so much utility in holding a stablecoin with no yield that they'd rather hold a stablecoin with no yield. Now, those same holders would like to hold a stablecoin and get yield, see open trade, but just on its face, the utility value of a digital dollar, of digital currency that's internet built and bred, is that high that these companies rightfully, in a market determined way, can capture this kind of seigniorage. This is somewhat the opposite of regulatory capture. They grew to this size without any regulatory support. In fact, regulatory hindrances. And so the technology is so value creative that despite uncertainty around the regulatory environment, they have grown to this size. And it shows you the power of digitally native assets.
One interesting thing that you made me think of, Ian, that actually should be mentioned in this introduction is that the business model of taking in deposits and paying out far less than you earn on those deposits is not new. So PayPal, Venmo, Cash App, they all do the same thing, right? The difference is they're actually far less transparent about what they do with the money that they take in. So when you use PayPal, you deposit money into PayPal, you get a PayPal balance, and you pay other people with PayPal dollars. Same with Venmo, same with Cash App. And they invest your money, right? They earn interest income on the reserves for money that enters their closed loop systems. They're just not doing it as a stable coin. And because of that, they're not telling anyone where the money is held, what they're doing with it. So it's actually a business model and even if you look at the banking industry, they're taking in deposits and they're paying a little interest, like unlike Cash App and Venmo and unlike stable coins, but not much, 10 basis points, 20 basis points. And so it's not, I don't want the context to be like, this is an egregious thing that like these stablecoin issuers are doing. They're doing what everyone else is doing and they're providing a tremendously valuable thing, as you've highlighted, Ian, which is an internet native dollar. But for a number of reasons, people are starting to look at that and figure out if there's a way that it can be done differently.
Yeah. And that brings us to how I'm going to frame up kind of the next part of the conversation, and then we'll start unpacking it. So there's 3 layers to the stablecoin digital asset RWA stack, right? You have settlement. Well, Dave, you just covered the middle layer is issuance. That's the one you just covered, right? That's Tether, that's Circle. They make up over 80% of the market cap. And then you have a plethora of others who are trying to also launch their own stablecoins. Another conversation for another time, whether those stablecoins are going to be able to really make it and survive and hit massive scale or not. But the first layer, the bottom layer, is the settlement layer. That's the chain on which stablecoins are actually settled. So right now, the big incumbents, the ones who are really winning in that space, that's Ethereum, one of the biggest, king of the L1s outside of Bitcoin. Then you have Solana and you have Tron. And then you have the challengers. One of them we're going to talk about a lot today, which is Circle's Arc. They just raised a big round with a lot of big names coming into that round. You have Stripe. They launched Tempo. And then you have two Tether-backed chains. One is Plasma, which is a Mercury portfolio company. And then you have another one, which Ian knows much more about, which is called Stable. And so those are really the challengers trying to be very specific to being the settlement chain. Then you have the top layer, which is yield. And that's what we're going to focus on today. And there's two kind of subcategories of yield. You have permissioned, and then you have permissionless yield products. And Wall Street is dipping their toe into both of them. So we'll cover all of that today. But let's first kick off.
It's going to be interesting. The settlement layer, it's all interesting. And the settlement layer, traditionally, a lot of the VC money and attention, and I think it's just natural, like people have built up the stack, has been focused on the settlement layer and the tokens that these blockchains issue, which are essentially, these chains essentially go public, right? But they don't do it through the traditional IPO process. They do it through an ICO process. And this has been attractive for investors because they buy these tokens and there's no lockup. They're immediately, there are some lockups now because of a lot of the regulatory scrutiny and some of the issues we've had in the past. But the settlement layer traditionally was the most lucrative. It's moved to the issuance layer now, where you have the Circles and Tethers who are making billions of dollars a year and having, in the case of Circle, blockbuster IPOs. And then the third layer, which is where Ian and I play, which is really on the yield side, both permission and permissionless. That's increasingly getting a lot of attention and investment capital and usage. So it's all three of these layers are kind of like chronologically, like we had to have the layer ones to get the issuance, right? You needed a chain that could handle high throughput, programmable digital dollar payments. Enter Ethereum, right? We had Bitcoin before that. It wasn't fit for purpose. Ethereum kind of changes that, and then all the derivatives on top. And then once you have the issuance and the sort of thriving stablecoin economy, you get the applications and utility layers that are providing yield on top of that. Enter, all the companies that you mentioned.
Yeah, so, just a piece of context, that's moving so fast. So when I met both of you guys over the past few years, we were talking about yield when a lot of people, it wasn't part of the common narrative yet. And now I feel like everybody is starting to really hone in on yield. And so luckily you guys are a little ahead of the game on that, but there is a lot to unpack and a lot happening in yield.
I mean, when we started these companies, the idea of having businesses in the investment world that were stablecoin native and stablecoin exclusive fundamentally challenged the most classic idea in business, which is meet the customer where they are. And so we basically, when we started Profiter, said, look, we believe there'll be so many trillions of dollars of investment in the settlement layer, so many trillions of dollars of investment in the education, which is an important part of this, in the distribution and all of this, that the customer will be there. We're going to go to where the puck is going because the global TAM for these investments is massively expanded through the global and ubiquitous rise of stablecoins. And so when we started this, the idea that we would open up some of these private credit markets to and be a coordinating function for instantaneous settlement was really understood. Like, of course, the heterogeneity in private credit markets needs an organizing, homogenizing actor. But then the idea that, okay, well, the only way you're going to be able to deal with instantaneous settlement is through stables. And by the way, we're going to make the bet that people are going to figure out how to be in stables as opposed to hold their hands and say there'd be so much investment that others would be that last mile, was quite controversial. Now, a year or so later, it's pretty clear that asset managers, global and domestic, investors, global and domestic, treasurers, global and domestic, if they don't today have a stablecoin wallet, whether self-custody or third-party custody, they will in the very near future.
It's absolutely table stakes now. I was talking to a founder yesterday, and they're building a tokenization platform for a different side of the industry we haven't covered. And he was talking about how everything is being settled on stable coins, and that's how they're differentiating. I'm like, that's stable coin. That's table stakes now, though. Like, everyone's going to be there. And I don't know when. It might be in the next year. It might be in the next 2 years, but it's going to be soon. So I think that's a really good transition because, as Ian's saying, everybody, including the big Wall Street institutions, which is a big core component of what we talk about a lot on the show, are leaning into this. And ARC, which is Circle's settlement layer, just announced this week that they raised $222 million in a pre-sale of ARC tokens. There's a lot to unpack here. This was at a $3 billion valuation. Andreessen Horowitz, A16Z, they led it. BlackRock, Apollo, ICE, the parent company in New York Stock Exchange, and just a list of the kind of who's who in the space joined in. Dave, kick us off.
Yeah.
I want to go two different directions, so you choose which one to go.
The ARC announcement. I want to give the listener context on why this is a big deal. So today, a vast majority of stable coins live and are settled on Ethereum. Okay? And that's been the case pretty much since stable coins were a thing. And as Samantha mentioned, there have been all these sort of independent blockchain networks, right? The shared public ledgers where the stable coins are actually tokenized and where their settlement is recorded, has been, a huge focus of investment. And the trend recently, which has been highlighted by Circle's announcement to build their own blockchain, right? Which was previously unthinkable, and I'll explain why, called ARC, where USDC, this would be a specialized blockchain for the settlement of its stablecoin USDC. And there's a number of reasons I think they want to do that. The reason this is important, and I guess not shocking to me, but maybe very interesting, is one, that it highlights that the issuers are moving down the stack into settlement and trying to basically become entirely vertically integrated. So they want to own the settlement layer, and I think they're doing that for a number of reasons. Potentially, one that we can talk about is their revenue is so tied to the Fed funds rate that if interest rates ever drop, their revenue drops linearly with the Fed funds rate. And so they need to find ways to make more money. Right?
Yeah, it's revenue diversification on one.
Exactly. So one. Two is, as we've seen in the past, there is this sort of money printing cheat code that these networks have, which is they can just issue non-dilutive equity, essentially, which are these tokens. For ARC, it is ARC tokens. And they can use that money to fund marketing budgets, business development, to pay incentives, to drive adoption of their blockchains, which then drives up the token price and keeps the money printer going. Obviously, there can be, as fast as that loop can go up, that loop can go down, as we've seen over the last year with sort of the token prices of a lot of these new L1s and L2s. The reason for me that this is so just crazy is if you rewind to 2 years ago, before the Trump administration, it was questionable whether stablecoin issuers were even going to be allowed to exist. Now, for me, it wasn't really questionable. There was a fair bipartisan effort to put through the Genius Act, but the Securities Exchange Commission and a lot of very prominent senators were extremely anti-stablecoin, anti-crypto, and the SEC was even, essentially giving kill orders to certain stablecoins. Like Binance's stablecoin that was issued by Paxos, I think, got a kill order from the SEC. Cease and desist, stop. On top of that, the idea that a public company could actually launch its own token Now that was a bridge too far. I mean, Coinbase was in a existential lawsuit with the Securities Exchange Commission. Ripple was in an existential lawsuit with the Securities Exchange Commission. Uniswap, blah, 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 blah. The regulators in the United States were trying to sue businesses into the ground, not even for launching their own tokens, but just, well, in some cases, in Ripple's case, but also in the case of Coinbase, just facilitating people trading these tokens. Fast forward 2 years, you have a stablecoin issuer that's gone public, that is issuing a stablecoin that is validated by a federal legislation, the Genius Act, and now they've launched their own token. It really is crazy. Like, oh, how the world has changed. And so why are they doing that? You know, I kind of touched on some of those, but it's a very interesting change of events that we've seen over the last 2 years.
I'd add a couple things for context for the TradFi listeners on this call. So shout out Palchek and the Natively Lab guys. In December of last year, I judged a hackathon sponsored by Circle to give pre-launch hackers an opportunity to create apps on Arc. And so to the folks that are seeing this for the first time and this announcement from Apollo and BlackRock and their investment, was that 6 months ago, we were sitting in New York, a group of 30 unbelievable teams across healthcare and a number of applications, invited by the Lab crew and Natively and Circle to come and do projects. And so I'd make a few comments. One, the team then knew they had a killer app. What was the killer app? The fluctuation of gas prices around certain blockchains, namely what you pay to produce blocks on a chain to record your transactions, is variable in almost every chain. But if you're in a dollar app having dollar revenues, you would like to pay the gas fees in dollars. Now at Profiter and at other companies, that gas fee payment is usually abstracted away or is increasingly abstracted away. So when we use Profiter, you don't feel the gas fees. We pay the gas fees. You know, it's de minimis on Avalanche relative to the other parts of the business.
It's like credit. It's like how merchants right now pay credit card fees.
But so we absorb the cost as an issuer of gas fees, and we're happy to do it. It's part of the user experience. But for many apps out there and for many people at scale who are thinking about this, especially agentically, where the cost of transactions, when the transaction size is tiny and you're doing billions a day, having a variable cost of gas, which is not denominated in the same currency as the cost and revenues of the application itself, is problematic and challenging and risk creating. So one huge risk that is reduced through Arc, through a dollar native gas, is reducing the currency risk of using the network. And we saw 6 months ago, a few points. One is, that's the interesting piece here for users and developers and for TradFi, is now the gas fees are dollar denominated. So your cost of running your app or your issuance is in dollars, your revenues coming in are in dollars, and your cost of running the network are in dollars. Not such a big deal when it's fractions of a penny, really big deal when you're doing billions of transactions agentically. So that's important. Everybody who's listening to this podcast about Arc right now must understand that's the huge value add, okay? That's one. Number two, to those in TradFi 6 months ago, we all knew this was coming. We were judging hackathons around it. Like, the space is moving faster, you know, quietly in the hackathon world, in the venture world, than it is in the mainstream TradFi world. I'd say this announcement relative to that hackathon shows you about the lag from where TradFi is getting things to what's going on in Web3. It's about 6 to 9 months. I think this is my own sort of mental marker. Like, you're not years behind, but you're like 6 to 9 months behind. And the world's moving faster. And so, but I'm just saying, from what, like, we knew Arc was coming 9 months ago. We were judging hackathons. We were looking at apps. We were seeing that this could be killer. You know, it wasn't MNPI if you wanted to trade Circle stock. Like, it was out there, and you could see they were working on these things. So I would say that.
It wasn't clear that they were going to do a token, though.
Was not clear they were going to do a token.
I didn't think that they were going to do a token.
Definitely wasn't clear they were going to do a token. Definitely clear they were coming with ARC. Definitely clear that they were going to get the fees associated with the ARC network. Unclear whether or not they would bring in other investors into the ARC network to share and benefit from those fees, as will now be the case with these investors. So there were two choices. One is they own the whole ARC network. They captured the gas fees associated with it, which were USDC denominated, and they kept it all in-house. Great. Or they created that as almost a second business unit, which is what they've done, remain major shareholders and let other people in. So they chose the latter.
Yeah, let me actually read what the CEO Jeremy said on about the announcement.
Super interesting. Yeah.
So he said, we're entering the operating system business, and we're doing it by building this multi-stakeholder distributed model with a token, with a distributed network. And then he goes on and says a few more things. And then he says, and almost an aside, he says, and we're also getting into the apps business, which goes back to what you're talking about.
To be clear, the winners of that hackathon 6 months ago were getting investments from Circle. Your compensation for winning the ARC Circle hackathon was them giving you money, whether it was whether it was non-dilutive prize money in the form of a grant, or what happened for some of the best ones of them was they got real equity investments from Circle Ventures.
Wait, so let's talk about the business model though, right? Because what Circle is saying with this announcement.
All I wanted to say, Samantha, is not only are they getting into the app business, but they were getting into the app business 9 months ago when they were hosting hackathons, having devs come in, giving them grants and investing out of their venture groups. So once again, you're about 6 to 9 months behind, the headlines from where these companies are, actioning their strategies.
Well, so what do we think this is going to be 6 to 9 months from now then? What are we seeing now that with these business models changing? What's happening that our listeners are going to care about?
Whether it's ARC or Stable, I think there's a real killer use case for having the native currency of gas fees be the same as the L1's blockchain. I do think that it's just, there's a real de-risking that goes on for companies and investors and everything to reduce that currency risk and reduce that gas fee risk. I think that there's real value there. Whether it's Stable with Tether and I'm no investment in ARC or Circle or Stable or any of them. So,
I actually think that's
just as an observer, I do think it's a really de-risking thing, and it's something that makes it easier for TradFi to lean in.
I think it's a secondary or tertiary thing, honestly. That's my opinion. So there are blockchains right now where, yes, you have to pay in Sol or AVAX or whatever. Incredibly cheap, though. We use Avalanche. We
absorb the costs. Yeah,
we use Avalanche for a ton of stuff. It's a great, cheap, fast, composable chain, and it's incredibly cheap to use, right? So there's a little bit of a benefit of having that be dollar denominated, but certainly not enough to change the trajectory. But wait,
I want to stay on this point. I want to stay here. Hold on, Dave. Hold that thought. I want to ask you a question. You're right when our ticket sizes are, for the value of the tokenized asset, 100 or 1,000 or 100,000 or 1 million, or when they're ticket sizes that are investment size. But when we go to an agentic future with a transaction size, when there's many more transactions and the transaction size is smaller, and the fixed gas prices as a percentage could be more variable, doesn't that change the math? Doesn't that, relative to today, yes. Would your opinion change if you were in a, many transactions, much smaller, agentic commercial framework?
Possibly, but I think first of all, possibly, and two, I think that future is still TBD. And so, again, I'm not saying there's no value. I think the reason it's not, let me put it this way. The 99.9999% of stablecoin users today are not waking up to this news and being thank God gas can be paid in USDC.
Right. I agree. I agree with you 100%.
The reason that Circle's doing this, or anyone would do this, is because they need a way to make money in other places other than interest income. and being able to issue a token is a money printing cheat code, period. Like, I think that there are technical reasons to do it. I think that those are not the primary priority. I think that you have to say that they're the priority, because you can't just come out and say, like, what I just said.
Yes.
Like, you know,
another whack at the pinata.
But, like, I'm not going to make this argument, but a lot of people could, which is like, the world doesn't need another blockchain. We literally have thousands of freaking blockchains. Like, we literally have thousands of blockchains. They're all...
And they work great.
Yeah. And so, like, I know a lot of, like, the L1 and L2 providers that currently settle a huge amount of USDC are really pissed off about this. Like, they're like, what the hell? Like, they had these really good relationships, and they, you know, put a lot of incentives into it. They helped Circle make a lot of money by being like the distribution for their tokens. And now it's like, oh, screw you.
Let's stay on that for a minute. I'm going to hijack this, Samantha, for a second. So here's an interesting dynamic. Coinbase helped Circle grow circulation of USDC massively. They have a huge commercial relationship that you know about, probably even more that we don't know about, between the relationship between Coinbase and Circle.
Isn't it 50% of the revenue that Circle gets through Coinbase's distribution of USDC goes to Coinbase?
It's enormous.
Yes.
I don't know the exact number, but
like
it's enormous. It's enormous. It's one of the most, it's like one of the biggest strategic tie-ups in the Web3 space is Coinbase and Circle, and they're independent public companies. But now they each have their own blockchain, right?
Yes.
How do I think about the Coinbase Circle relationship in the context now of Base and Arc? Interestingly, does Arc opening itself up to external investors mean that we should expect Base to open up to external investors now?
Yes, and there was a very, like, public debate, potentially even argument, well, definitely argument, between the Circle teams that built USDC and the Coinbase teams that built USDC. You know, Balaji on the Coinbase side, a number of people on the Circle side, where they were essentially arguing over, like, who was responsible for USDC's success. It used to be a 50-50 joint venture between Coinbase and Circle, which my co-founder and I both worked at, until it was dissolved in exchange for this deal that we're talking about. So you've seen a divergence of interests there already. Like, Coinbase has made some pretty big press releases about incentives campaigns that they're running on other stablecoins, right? Not just USDC. Now, USDC still is, just to be clear, in my opinion, by far the best stablecoin in the market, right? It's Genius Act regulated. It's the most transparent. It's the safest. It uses the best counterparties. It is, in my opinion, an excellent company by all means.
Dave, is that for the global population too, or you think just specifically for US?
That's my opinion, but by the most used stablecoin globally is USDT. In terms of market capitalization, now USDC has been making huge headwinds in terms of transaction volume and its growth in monthly active users and wallets. But USDT still is the king, and I think a lot of that's network effects.
I'm having an out with Dave today on a few things. Or just really asking him some questions and learning from him. So I agree with you on Circle and USDC, and I think they've done a lot of things right. But if you were to go over to Anchorage, frankly, Anchorage is trying to pull the plug on native support for USDC. You know, Anchorage has their own stablecoin that they want to put out there. Anchorage, arguably the tier 1 OCC charter bank custodian for digital assets in the US, a major player, super important. They haven't hidden the fact that they're coming with their own stablecoin, and in doing so, they've reduced support for USDC. So the question becomes, where is the most valuable real estate to own? If Circle's going to compete, if Coinbase is going to compete with Circle, and Anchorage is going to compete with Circle, and they own the last mile user at the custodial level, and at the wallet level and at the exchange level, does that force, because now there's competition, that these guys see the money in that seniorage, does that force now Circle to be a different business where it has to be a more enterprise focused blockchain because they're seeing a reduction in support and a reduction in distribution from the Anchorages and the Coinbases of the world?
You bring up a very interesting point. And so what you just highlighted is that amongst these three layers, settlement, issuance, and the app layer, companies in one, like the Schrodinger's cat, are showing up
Yes.
all of a sudden in other layers, right? And they're doing it for the same reason Circle's moving into the settlement layer, which is they want to own more of the stack so that they can have more control and make more money. So the world doesn't need another stablecoin, just like the world doesn't need another blockchain. There aren't like people crying out, God, we need Anchorage's stablecoin. Oh my God, what would we do without it? Because Genius actually makes them like fairly commoditized. Like
100%.
they all kind of like, they're backed by U.S. treasuries, they're issued by their bankruptcy remote, issuing entity. But it kind of like homogenizes the issuer, right? And so that's why everyone's like moving around these different layers, because they're like, shit, actually, like, they have these existential threats to their business models, and they know they need to expand outward so that they're not so prone to some type of takeover or competitive pressure or shift in rates environment.
And by the way, that's before Bank of America and JP Morgan or any other of the big G-SIFI money center banks decide that they want to be in the stablecoin business, and all of a sudden they've got a lot more distribution when it comes to users than any of the other native Web3 businesses that we've referred to.
Yeah. And so Anchorage is looking at like Circle and Tether and being like, shit, they're making a ton of money. This seems like an easy job. Like, take in fiat, invest in a money market fund, take all of the interest. Why can't I do that? Anchorage, I own a bank, right? I have custody infrastructure. I know Web3. And so their thought process is probably similar to Circle's, which is, hey, I'm doing this issuance thing really good. This blockchain thing looks really easy. Fork some L2, add some changes to make it better, boom, launch a token, make a bunch of money. And so it's a little bit flippant. Like, I know that there are like at technical levels differences between all of these things, and there's probably good reasons why you.
Yeah, we're gonna get a ton of hate mail for this podcast, dude. The amount of emails that the two of us are gonna get from almost every brand name we've just dropped.
No, I actually don't think there's that good of a reason when you think about the consumer and the user to launch your own stablecoin. I think people are just doing it because right now it's an absolute money grab, which goes it's a land grab. It's a land grab. And so that's actually an interesting question, is like, what does that mean for the stablecoin landscape in 1 year from now, right? So like, where does USDC, because right now USDC has the network effects. And people are going to try to unwind that, but I think that we've seen this actually happen a few different times where people who are Hyperliquid's one of them. They were trying to do their own stablecoin, and they were trying to do their own stablecoin so that there would be less reliance on USDC. That didn't really work because the volumes were still all happening in USDC. And so now they're trying again with another announcement they just made with Coinbase like last week. And Coinbase is actually helping them do that. So I'm still trying to figure out what this means for Circle, what this means for like the dominant now US one, USDC, and for Tether. But what does that mean for them over the next, 6 to 9 months when everyone's trying to just money grab and land and launch their own stablecoins?
I'm trying to think of an analogy. Network effects are incredibly important in a stablecoin, to a stablecoin's utility value, because one of the key characteristics of money is that it's ubiquitously accepted. So like, if you have a stablecoin that no one accepts, it's kind of like being the only person in the world with a telephone. Like, the telephone theoretically is great. It's way better than paper, like sending, letters over USPS. But if you can't call anyone, it's kind of just like, it's just a brick on your desk, right? And so you'd much rather send paper letters. And so the key is the acceptance amongst merchants, amongst market makers, amongst exchanges, amongst wallets. If more people will agree to buy and sell things in your currency, it's more valuable and more people will use it. And that's a a self-fulfill, that's a feedback loop, right? And the only way that you can break that is like, if you, and we've seen this happen in the past, is like almost like seizing these huge pockets of users and like forcing them into a conversion or an acceptance of some new stablecoin. Binance did that. So I generally think, like, unless those things happen, Tether and USDC continue to grow and the world is their oyster. But Ian mentioned one, which is banks could just like say, we're going to support stablecoins, but you have to use our stablecoin. And then all of a sudden they start forcing people. First of all, they increase the utility value because now anyone that has a bank account can use Bank of America coin.
Or maybe they do a little bit more discreetly than that. Let's just think out. So maybe instead of mandating that the only thing that Bank of America supports is Bank of America coin, they say, well, you can buy all Bank of America wealth management products with Bank of America coin, and if you do so, you'll get a discount on the management fees for the wealth management product, right?
They'll do both.
So that you could get into a place where you get discounts on other Bank of America financial services, and imagine this for a vendor, right? Use the Bank of America stable as a, for your vendor. So use the Bank of America card for stables. So now MasterCard's cut out. I've got a Bank of America card on my iPhone anyway. They get vendors to sign up for that, and they get, maybe it's not yield to the Bank of America stablecoin holder, but it's a cashback reward to the vendor who accepts the Bank of America token. So, Bank of America's got so many diversified financial services, from card services to wealth management to the rest of it. They can incentivize the growth in their assets under management in their stablecoin through many other ways that are not necessarily just paying yield to stablecoin.
I think they'll do both, but the forced conversion has always been the most successful. So like Binance did this. Like Binance, I can't remember when, it was within the last 2 or 3 years, said we're delisting USDC. So we're no longer going to support USDC. All the trading pairs are forced migration to Binance's stablecoin. That put a serious dent in Circle's market capitalization. Now, it ultimately didn't work, right? But if you have enough, because it wasn't enough to tip the scales, because USDC, the Circle kept plugging away at real world use cases and merchant adoption, and so they
by the way, and Coinbase, and they had Coinbase, which was huge. I mean, had you not had Coinbase at the time that Binance did that, we may be in a very different world right now.
Right, and so that, to me, it's like, to win the pie, you need someone with enough of an oligopoly to do a forced conversion, to eliminate the choices that the consumer has. I don't think that's a good thing, by the way, but that to me is that's how you break up a network effect. Or you acquire one. Ripple tried to acquire Circle. Ripple has its own stable coin. They, tried to use XRP as their own payment network for however many years. It didn't work, so they're like, same thing Anchorage, same thing everyone did, which is, this stablecoin business seems easy. We're going to launch our own. And then they tried to acquire Circle. They were basically going to buy Circle's network and then convert everyone to XRP stablecoin. Didn't work. Circle IPO'd, and it was still a shocking offer that they made. But yeah, I think that's how it works. But
do you remember what XRP offered Circle for the buy?
I think it was $12 billion.
Wow, so that's more than Circle's current market cap public.
Yeah, but it was all in XRP. And so, the market can't take that much sell-side pressure from XRP.
That's a lot of XRP on the market.
By the time the transaction's done, your $12 billion in XRP is probably worth $3 billion.
Exactly.
And so I think it was quickly rebuffed. But this dynamic of these players moving between the first layer of settlement, the second layer of issuance, and the third layer of the application layer, and the primary application today being yield, is really, really interesting. Who owns each layer, how different players move across and between them, how they collaborate. I think that dynamic is is going to be one of the most important dynamics for how the business models and and thus the profitability of these companies evolve going forward.
I agree.
100%.
For sure. So, okay, let's move on to then actually a piece of that on the yield layer.
Yes.
Perfect transition for us, Dave. Way to go. So, BlackRock launched a new tokenized treasury reserve fund last week, I think is when it was announced. Who wants to take this? First, explain to our listeners what the difference between this tokenized treasury reserve fund is that BlackRock launched versus their BUIDL fund, which was their first kind of go into this space. And why is it useful?
There's a concept here called HQLA, high quality liquid assets. And there are some regulated financial products, such as money markets and other treasury type products, that to have their designation and be part of a particular asset class and to be defined as one, their HQLA needs to be X percentage of assets. For stablecoins, HQLA basically needs to be pushing 100%. So high quality liquid assets, what does that mean? It basically means there are some exceptions to this, but short dated US T-bills. Why short dated? Well, the 30-year treasury moves around a lot. The 3-month T-bill does not. I mean, everybody listening to this podcast understands how fixed income duration works. We'll just take that as a given. But we have this concept of HQLA, and one of the things that to be Genius Act compliant, you need to have high quality liquid asset ratios that are very high, basically pushing 100%. And so what does that mean for a stablecoin issuer? They issue a stablecoin, it's a liability, it can be redeemed for cash, and you need an asset to offset that liability. Well, what assets can you own? HQLA. Well, who manages those pools of HQLA? Well, here it's this new product that you're referring to, and this is common in the commercial paper and space. It's common in the money market space. We talk about money markets not breaking the buck. You can always redeem at $1, and having that kind of liquidity and that lack of volatility. There are major institutions that are in the business of managing that cohort of the fixed income market. And obviously BlackRock's a major player in that space. There are a couple other really big players, and they've said not only do we want to be BUIDL, where people can hold treasuries and take on that duration risk, which can be good or bad, take a bit of a yield pickup in a positively shaped yield curve, but now we want to be in the place of stablecoin HQLA tokenization. We own that in the TradFi space. Let's try to use that same architecture and that same brand to own that in the Web3 space.
Yeah, and the biggest buyers, go through who the biggest buyers BlackRock plans on being for this product.
Well, every Genius Act compliant stablecoin is going to buy, I think, will either hold these HQLA on their own or will own the BlackRock managed HQLA. But there are other major financial institutions that aren't stablecoin issuers that have reporting in HQLA. Banks, for example, money market funds, commercial paper funds, insurance companies, people that need to be rock solid in their ability to provide liquidity to their customers. Not that, US treasuries are, have on a lot more default risk, although obviously longer duration, anything can happen. It's that duration, the time value of money is greater over time. So that has a market fluctuation, so you need shorter duration. And there are many financial institutions that need to be able to give people $1 back when their NAV is $1, and that's HQLA, and that's managed by BlackRock.
So what you're seeing here is a similar dynamic to what we discussed in the prior segment, which is how these different layers, how different companies are attacking them and attempting to sort of capture the economics of them. So within the second layer, the issuance layer, there's actually a few different key service providers that allow that issuance layer to happen outside of the issuer themselves. One of them is, the collection of them are the institutions that manage the reserves backing those stablecoins, right? And just like everyone's looked at stablecoins and said, issuance can be a very lucrative business, the institutions that will be involved in managing those reserves have said, hey, that can be a really lucrative business. You mean to tell me I could all of a sudden start managing 150 or a trillion or $2 trillion worth of treasury securities for one client, Circle or Tether? Hey, this sounds great. And so that's basically what you're seeing here. That's what and they've been doing this for a long time, by the way. This is not new. So Circle had BlackRock set up, I think, even when I was still at Center, so 2023, the Circle Reserve Fund, which was a money market fund with one client, and that client was Circle. And so Circle would take in $1, mint 1 USDC, and it would take that dollar and it would send it not to BlackRock. BlackRock was the fund manager. The Bank of New York Mellon was the custodian and the transfer agent. So they'd send it to Bank of New York Mellon, and then BlackRock would take those dollars and do all the buying and selling and rebalancing of the actual underlying treasury securities. And it was really great for Circle because they could say, in terms of their transparency, hey, you want to know that every $1 of USDC is backed by $1 of commercial bank deposits or money market funds? Just go look at the ticker X. I can't remember what it was, like X Circle. It was a ticker for the money market fund. You could pull up on BlackRock's website and you could see the money market fund and everything that it held and all the repo arrangements it had and all the treasury securities it had and all the different maturities of those treasury securities. And so because now everyone is saying, oh, this issuance layer is pretty lucrative, BlackRock's just following the money and saying, well, shit, why don't we build a Circle Reserve Fund, but allow other stablecoin issuers to participate in that fund? It's as simple as that. It's really simple, and it's pretty smart. I don't know how differentiated it is, though, to be completely honest. Like Cantor Fitzgerald does all of Tether's stuff. What's it called? Van Eck. There's a stablecoin called issuer called Agora, right? It's issued by someone related to the Van Eck family. So Van Eck does all the management of their stablecoins, right? I think, so all these institutions are basically competing to manage the reserves for these stablecoins. And BlackRock has come out with what seems to be more of a general purpose one that's being marketed as Genius Act compliant. It's kind of been built to be plug and play. You want to issue a stable coin? Come talk to us. We'll manage your money. And so it's interesting, but to me, it's just a very natural extension.
I think that's right.
What these other institutions.
Yeah, it's just showing adoption. It's showing that there's continuing to be enough growth in the space and legitimacy in the space to where people are going to keep people like BlackRock are going to keep putting out major products.
Yeah,
it's great for our businesses because if there's this risk-free yield layer, this tokenized, whether at the stablecoin level, and now you're having, this HQLA level that's right where that T-bill is, that means you're going to build up a whole fixed income ecosystem on top of it. That means your next stop is probably mortgages, right? So your next stop is investment grade credit, and then you go to high yield credit, and you got structured credit, and you've got repo facilities on it, you've got leverage on it, and now you can't. It's very hard, and maybe this has been the biggest problem with Web3 and crypto. It's very hard to build a capital stack that goes from the longest duration, highest risk, highest return. So what is that? Equity or token in a network, or think about that. It's really hard to start to build a financial ecosystem from the outside tails in. But actually, it's much easier to build a financial system from the inside out. So inside being the shortest duration, lowest risk, highest quality. And so what you naturally do, before we had a high yield or CCC bond market, that was an anathema. In the 1980s, when Michael Milken came out with high yield bonds, that was a small market because that had to be built into once you had a liquid treasury market and then a liquid investment grade market and then a lower investment grade market. And so the natural progression for TradFi into fixed income broadly and globally was to start from shortest duration, highest quality, and then move out. In a weird way, like Web3 started with the most high-flying, longest duration, most complicated, highest risk stuff and said, okay, why do we have no high-quality collateral inside Web3? So we had this really weird thing where we had all this like really right tail wingy stuff, and we didn't have like the high quality collateral that was needed for internet money. Now we're building super high quality, base layer, and now it allows us to create and distribute globally the yield pickup products and fill in the rest of the portfolio management distribution.
There's demand for it, right? So
Sure.
This all comes from people want a better dollar. So that drives demand for stablecoins. The stablecoin issuers then drive demand for HQLA, and the market's meeting that demand. Like it's like what we were talking about earlier. Tether and Circle are equivalent to a fund manager getting all of Saudi Arabia's U.S. Treasury holdings, or all of South Korea's U.S. Treasury holdings, so like those are just massive potential clients for these asset managers. And so I think it's being done the right way, which is like people aren't just like, if you build it, they will come. Like Web3 and tokenization efforts, believe me, we've done a lot of if you build it, they will come, and they have not come, right?
Yes. 100%.
Yeah.
100%.
And so like
tissue we all have.
This seems like a very healthy dynamic, which is like
and what you'll see
dollars,
and the next couple layers will still be will be intermediated, but you can see now a vision for less intermediated, more direct to investor issuance from companies. Like this allows you to imagine a world, maybe you'll have super IG credit in 2027, where when Apple or Facebook wants to sell, it's a tokenized bond that they sell, and it settles against stables, and it happens pretty instantaneously. And you get, you'll get IG corporate issuance. I mean, certainly you would envision the public Web3 companies, if they're issuing debt, to issue it directly on chain. Like, why wouldn't, if Circle raised debt financing, why wouldn't it now issue on chain? It's just filling in more and more of what the asset distribution curve should look like. And I think in 2027 you'll start to see more issuance fill in more and more of these pieces, and that's going to just create more choice for investors and savers.
Yeah, for sure. Okay, guys, we went deep onto the ARC discussion, which is good, which means we're going to skip our next two sections, which was about permissionless yield, but we can cover that. We kind of covered that in our DeFi episode, but we can cover it more in a later episode. And where the next big value creation is, which we hit on, but we didn't deep dive on. And that's on, is it still on the core infrastructure layer? Is it on this yield layer? So
next episode. Those
next
are both
episode.
Really interesting topics. Yeah.
That we can spend a lot of time on. So let's go ahead and close out though. As I know y'all's favorite section, the signal, which is where you have to think about everything we just covered today. And then in a few sentences, tell us, what are you watching relative to this topic that you think is going to play out over the next timeline that you choose, whether it's 3 months, 6 months, 12 months?
I always go last, so I'm going to go first because I'm always thinking. But now I know exactly what I'm watching today. Are other public companies going to issue their own tokens? That would be crazy. Like, has Circle just like laid the groundwork? Like, does that mean Stripe and Tempo, they're going to issue a token? Does that so now public companies that want to play in the stable coins, is the playbook now launch chain issue token? Like that would be a crazy dynamic. I'm not sure if it's good or bad, but it will still be just based on the historical context of like 2 years ago, if you did that, you're possibly going to jail. Now you're able to do it with the full, I'm just watching that out of interest.
They're accounting for it on their balance sheets.
Yeah, it's wild.
I mean,
so let's talk about it for a second, though. Like, why did BlackRock and let's say the more financially driven institutions, as opposed to maybe some of the more strategic driven ones, and why they invested in ARC? Is this going to be the typical L1 play, to where all the early investors in the private pre-sale make a bunch of money, and then everyone else who buys it at the public launch gets left kind of holding the bags? Because that's kind of how.
Well, the problem for a public company that's trying to be sort of a Main Street American company like Circle or like they can't run that same playbook. The reputational hit's not going to be the same. They're under more scrutiny. There's more regulatory oversight. I think it'll be trickier for them to play the same games, but that won't stop them from doing it.
I was going to say, maybe it will be trickier, but they still might do it.
It'll be trickier, but it won't be. Look, we're sowing the seeds of 2031's update of this regulation. Like, we don't know. We know the good things that are going to happen. We can kind of understand what the risks that are going to happen, but we know we're going to make some mistakes culturally, socially, financially, legally, and we'll fix them in an update.
Yes, but if they run that play, that is a known mistake that they are specifically choosing to do just in the chase of making a shitload of money, which this is a capitalistic society. But we have to, I hope that we learned enough of our lessons to say we're not going to claw back all the legitimacy that we have gained over the past few years.
And Circle is genuinely a good actor. Like, this isn't a pump and dump play for them. Like, we see a lot in the token stuff. Like, unless they prove otherwise, we should assume that they're an ethical good actor. Like, because they've proven that over the last decade.
Yeah.
But what we've seen is that actually doesn't matter. Like, Coinbase was an ethical good actor, and like under the past administration, the Securities Exchange Commission tried to give them the death penalty, right?
You don't even need to go to the sort of the nervous system of this industry. Fannie and Freddie was a good actor, a lot, but you got looser and looser on the margin. I mean, a lot of Americans have homes because of Fannie and Freddie and love their homes and raise their families in those homes. The good that Fannie and Freddie, despite '08, has done socially probably outweighs the bad. Yeah. But that doesn't mean Fannie blow up and need a bailout. I mean, there's a lot of these things can marginally get looser and looser, and that's just the nature of a dynamic society. I think we'll accept those risks. But these actors aren't doing anything wrong per se. I think you bring up a really big point: is do we want to go to a world where we already have a lot of fragmented liquidity in Web3? Mm-hmm. If all the major banks are going to have their own blockchains, and every payment processor is going to have its own blockchain, and every social network is going to have its own blockchain, that's not going to be a great user experience.
No.
It's not a good use case in general.
It's not what we need.
It's not going to be good.
We have too many blockchains.
Agreed. Let everyone know loud and clear, we have too many blockchains. Yeah. No more blockchains are needed.
Yeah. Man, okay. the emails we're going to get on the back of this.
So that's my signal. Let's hear yours.
Ian. You're up.
I think, okay, so I agree with that. I think that's worth watching. I think what I want to see now is what we touched on, which is the building up of the digital capital market space. So now we've got BIDL, we've got HQLA. We'll see more commercial paper out there. We see tokenization of really high quality private vehicles, whether that's Hamilton Lane or Apollo. We see what Figure's done in the HELOC space. Like, I think now you're creating a base yield, in a high quality part of the fixed income market. And now you're going to be able to see more and more come directly on chain and take advantage of instantaneous settlement. And I think that's we haven't covered that at all today, but one of the great advantages to stablecoins is instantaneous settlement. And so if you can now have more acceptability of digitally native yield product, then that matches really well with how we got here in the first place, which is the need for instantaneous settlement. Yeah. And so I think what I'm looking for is who's coming with high quality product, not we will build it and they will come. I mean, in all fairness to the real estate on chain crew, there's been a lot of money that's gone into putting real estate on chain and Vail resorts and everything else. Like, there are big $1 trillion liquid markets out there where we know there is product market fit for those financial products. If they can slide into the stack right now, the duration stack, the risk stack, the yield stack, they can fit in nicely now because there's things that they're built on top of. and we have credit rating agencies that'll step in and look at it and continue to use their fundamental analysis. But with this new settlement layer, I think that's a really big deal. And then you will see stablecoins go from 300 billion to 3 trillion really fast, to 30 trillion really fast.
Yeah.
A lot to watch.
All of those things, of course, and we've covered some of those in depth, but Mine, I'm pulling it up. It's pretty simple, but I'm pulling it up just a little more high level. So it's like the reason why blockchain is so interesting, which we've covered on so many different episodes, and especially with RWA and stablecoins, is because it gives financial access to a lot more people around the globe. And when you think about yield and you think about that yield layer and what people are able to do, not just outside of the US, but even in the US, this gives people so much more control. Potentially, if we do it right and we have the right distribution to own that last mile that you talk about a lot, Ian, if we own that last mile to the consumer, to the retail investor, and just to the saver, then this can be transformative for what people are doing with their money. And that's what gets me super excited. And so when we talk about figuring out that yield layer, I think it's really important to figure out what that looks like for our capital markets and our financial institutions, but it's really important also to figure out what that looks like for consumers. So
just so happens, Ian and I are actually working on that problem.
Yes.
It just so happens I made investments in both your companies, maybe because of this.
No, it's good. It's a good signal to watch. We are also watching that.
Yes.
All right, guys. Good job.
Amazing.
Another
Thanks,
good one
everybody.
in the books.
Have
See
a
you
good
next
one.
week.